So here, so any items, the income under the head, when you are computing the total income of an SSC, you'll have to take the 5 heads of income. Okay, in each of the head, you will have separate calculations to be made, and a comprehensive problem will be given to you in your examinations. Okay, this is one such comprehensive problem where he has given you some items related to salary, and he has given you, I think, items related to that's it. He has given you one house situated in Madras, that also is coming under salary. So he has given you items with relation to salary. He has given you income from other sources straight. He has given you long-term capital gains. So long-term capital gains and income from other sources you have to take directly because there is no calculation involved. But in the case of salary, you will have to calculate which part has to be taken into the statement that we have seen in the last class. Okay. So if you see the total salary of the employee, turn to the next page. That would be page number 73, I think. Now there, if you look at the solution given to you, he has taken the item salary, that is total salary that is payable to him is 3,60,000, that he has taken directly under the subhead salary. And then project allowance. I was telling you allowances are of 3 types. If the allowance is fully taxable, that will be taken directly into the statement. So he has taken project allowance 10,000 directly into the statement. Then rent-free accommodation. What are the provisions related to rent-free accommodation? If the accommodation is owned by the employer and provided in a big city, 15% of salary is the value of rent-free unfurnished accommodation. If the accommodation is provided in a medium city, then the value of perquisite is 10% of salary. If it is provided in a small city, then it is 7.5% of salary. Now, what is a big city, medium city, and small city? He will give you in the problem the population of the city. If the population of the city is more than 25 lakh, it is a big city. He will give you in brackets accommodation provided in a city where the population is 25 lakh, then it is a big city. What is a medium city? A population which is less than 25 lakh, but more than rupees 10 lakhs. Okay, that is a medium city, in which case the RFA valuation would be 10% of salary. If the population is less than 10 lakhs, then it is a small city where the RFA value is 7.5%. Now, in this case, it is provided in Madras where the population is more than 25 lakh. So therefore, 15% of salary is the value of rent-free unfurnished accommodation. Okay. So 15% of salary is how much? 3,50,000 plus 10,000. That is 3,70,000 into 15% is 55,000. Now here, he has given the accommodation, but the employee is paying rent towards the accommodation. How much employee is paying rent? 36,000. So the accommodation value as per the income tax rules is 55,500. But the rent paid by the employee towards that accommodation to the employer is 36,000. So from the perquisite value, deduct the rent paid by the employee, that is 55,500 minus 36,000, 19,500 is the value of perquisite. 19,500. Okay. Then from the salary, there are 3 deductions that have to be given. Okay, 3 deductions from salary. First one is standard deduction. Standard deduction is always 1/3 of gross salary. Whatever is the gross salary, of that, 1/3 is standard deduction. In certain cases, you have to see 1/3 of gross salary or rupees 50,000, whichever is less. Okay, first take 1/3 of gross salary. If that 1/3 of gross salary is less than 50,000, take that under 16(1) standard deduction. If 1/3 of salary is more than rupees 50,000, then standard deduction is limited to rupees 50,000 only. Okay, that is 16(1). I told you there are three deductions under salary. First one is 16(1). Second is 16(2). 16(2) is exempted entertainment allowance. Exempted entertainment allowance. Now, what is exempted entertainment allowance and how much is exempted? In the case of entertainment allowance, the least of the following three, that is, out of these three, whichever is less is exempted, remaining is taxable. Okay, first one, actual allowance received. Second, 1/5 of salary. Third, fixed rupees 5,000 per annum. Out of these three, that is actual allowance received, 1/5 of salary. Salary means basic pay only. And third, a fixed amount of rupees 5,000 per annum. Out of these three, whichever is less is to be shown as deduction under 16(2). Okay. The third one is 16(3), which is professional tax paid. If the SSC pays any professional tax, it will be given as deduction from the gross salary under section 16(3). Okay. So from the gross salary, when you give deductions under section 16, that is 16(1) standard deduction, 16(2) exempted entertainment allowance, 16(3) professional tax paid. When you give these three deductions, what you get is called income from salary. Okay. So what you get is called income from salary. When the three deductions from the gross salary are provided, what you get is called income from salary. Now, this income from salary has to be taken into the statement and it has to be shown in the entire statement under the computation of total income of the SSC. Okay. Then just give me 1 second. I am printing the screen because this print screen has to be done by us. Okay, sorry. Coming back. So this is the gross total income, and from the gross total income, in your previous class, I've told you that there are exemptions to be deductions to be given under section 80. What was those deductions? The first one we have seen was 80C. Under 80C, we have talked about the contribution to Provident Fund. When the employee contributes to the Provident Fund and it is SPF, it is qualifies for deduction under section 80C. When the employee pays life insurance premium, okay, that also qualifies for deduction under section 80C. So in this problem, you have got deductions from the gross total income. 80C is in respect of life insurance premium. He has paid 10,000 towards life insurance premium that you have to give under 80C, and 80D he has paid medical insurance premium that also has to be given under section 80D, and 80G is donation. So total of all these three deductions, when you deduct from the gross total income, what you get is known as the total income of the SSC. Okay, that is about this problem. Then coming to the next illustration. Now here, are you having the material in front of you, Lakshman?
Yes, sir.
Okay. So look at page number 73. In that, I will just discuss the problem and then I'll tell you whether it is taxable or not taxable and taken or not taken. So here you see the second problem. Sri Prem Prakash has given you certain particulars of his income. Okay. Now, whenever you are looking at the problem, look at the item of information given, determine whether it comes under salary or house property or capital gains, like that. Okay. Usually 70% of the items given to you, they will come under income from salary only. 70% of the items. One or two items they will give from house property, one or two items from income from capital gains or other sources. That will be the major thing, salary. So here they look at the items that are given to you. Salary is given, which comes under the subhead salary, bonus, dearness allowance, contribution to recognized provident fund, interest rated to provident fund. Okay. And he is given a rent-free accommodation, and the company pays life insurance premium. These are the items that are given to you. First item is, what is the first item? Salary. Salary, he has given you salary 2,000 per month. So take this salary directly into this statement under this subhead salary. Call it as basic pay 2,000 into 12. In the outer column, you put 24,000. Okay. The next, bonus. Bonus is given as 2 months of salary. Okay. So bonus here, 1 month salary is how much? 2,000. So 2 months salary is 4,000. So take bonus directly into the statement. Then dearness allowance is 20% of the basic pay. Okay. So basic pay here is how much? 24,000. See, do not include bonus, because bonus will be included only when it is paid as a percentage of turnover achieved by the SSC, which is an incentive bonus. Normal ordinary bonuses will not be calculated as part of salary. And dearness allowance, when dearness allowance will be calculated as part of salary? When dearness allowance enters for retirement benefit. Like that, he will give you the problem. DA enters for retirement benefit. Then you will take a DA. Otherwise, it is basic pay. So in this case, 24,000 and 2 months of the dearness allowance is 20%. That is 4,800. Then coming to the next important thing, employer contribution to provident fund. Okay, employer contribution to provident fund. In your last class, we have discussed about provident funds. Provident funds are of four types: SPF, RPF, URPF, and PPF. Okay. Regarding SPF, employee contribution is a qualified saving. Employer contribution is fully exempt from tax. Interest is fully exempt from tax. That is SPF. Now, in this problem, he has given you RPF, that is recognized provident fund. In case of recognized provident fund, any amount contributed to the provident fund up to 12% of salary is exempted. Remaining is taxable up to 12% of salary. Now here, how much he has contributed? The employer has contributed 15% of salary. How much is more than 12? 3%. That 3% is taxable under this subhead salary. Okay, you call it as excess employer contribution over 12% of salary. Employer contribution over 12% of salary is taxable under this subhead salary. Okay. The next, interest credited. Now, when it comes to interest credited to recognized provident fund is exempt up to 9.5%. Any interest contributed above 9.5% is taxable. Okay. Now here, in this case, how much is interest credited to the provident fund? At the rate of 11%. So for 11%, he is getting 1,100. How much is more over and above 9.5? 2.5%. Yes or no? He has been paid 11. Up to 9.5 is exempted. So how much would be taxable? 2.5 would be taxable. So if 11% interest is 11,000, 2.5% is how much? Cross multiplication. 2.5 divided by 11 into 1100. Okay. So 11, out of 11%, 2.5% is taxable, and that taxable amount comes to 150 rupees. Okay. So you have taken 150 only into the statement. So then here, rent-free house is there. Okay. Now here, when the employer is paid rent-free accommodation, now in this problem, can you tell me whether the accommodation is provided in a big city or small city? Looking at the problem, can you tell me, is it a big city or a small city? Lakshman, are you there, Lakshman? Okay, so in the problem, he has clearly mentioned that accommodation is provided in Madras, which is a big city. Yes or no? So in case he doesn't give you the population, then looking at the name of the city, you have to assume whether it is big or small. Okay. So Delhi, Bombay, Calcutta, Madras, Hyderabad, Bangalore, like that major cities, when the name of major cities is given, take 15% of salary. If a small city like Surat, okay, is given, take only 10% of salary. Okay. So here, employer is provided and employee is provided accommodation, and the perquisite value is 15% of salary. Now, in this case, what is salary? Salary means basic pay plus bonus. Okay. These two items will come. What was the definition of salary for RFA? Basic pay plus bonus plus commission plus all taxable allowances except DA. Okay. Where DA enters for retirement benefit, DA also will be included. This is what we have seen for salary definition under RFA. In this case, what are the items that will be included for the purpose of salary? Basic pay plus bonus. Okay. Employer contribution over 2.5%, employee interest over 2.5%, all that will not be considered. It is only basic pay plus bonus. Out of these two, okay, you have to take 15%. That becomes the value of perquisite. Okay. Then life insurance premium paid by the company. Now, life insurance premium actually is a deduction under section 80C. But who should be paying the life insurance premium? Life insurance premium has to be paid by the employee himself. Where the employer pays life insurance premium on behalf of the employee, it becomes a perquisite which is taxable. Okay. If life insurance premium of the employee is paid by the employer, club bills of the employee paid by the employer, mobile bills of the employee paid by the employer, okay, travel accommodation in hotel, all these paid by the employer will be perquisites that are taxable. Now, in this case, the employer has paid the life insurance premium. That is why you are taking that under perquisite. Okay. So that is the life insurance premium. A total of all this is known as your gross salary. Okay. And what is the amount of gross salary? 44,870 is the amount of gross salary. Then deduction under section 16. What is the amount of deduction under section 16? Tell me. 1/3 of gross salary or 50,000, whichever is less, should be given as deduction, and income from other sources is added directly because that is given to you directly. And from the gross total income, you have to give deductions under section 80C, that is contribution to RPF, life insurance premium, and premium paid by the assessee. These three will be given as deductions under section 80. So from these, when you give deductions under section 80, what you get is called income from, that is the total income of the assessee. Okay. Then now I am going to tell you the next important head of income, which is known as income from house property. Income from house property. Income from house property, any rent received from the letting out of a house property by the owner is taxable under the head income from house property. Okay. Here I am saying any rent received by the owner of a house property given on rent is taxable. Okay. So there should be a house. The house should be owned by the assessee. The assessee should give this house on rent and he should be getting income from that. When these conditions are satisfied, any income that arises is taxable under the head income from house property. Okay. Now here you have to take one important factor into consideration. That is known as annual value. Annual value of house property. Okay. Now what is annual value? Annual value is the value for which the property is reasonably let out. It is the income earning capacity of the house that is taxed, but not the actual income received. Why? Because the SSC may say that he is giving this house on rent only for 1,000 per month. If you take only income received by the SSC into consideration, he will show only 1,000 per month as income. So that is why under the Income Tax Act, you have to show the annual value of the house. What is the meaning of annual value? Annual value is the value for which the property can reasonably be let out. Annual value is the value for which the property can reasonably be let out. So to calculate annual value, there are three important factors that have to be considered. The first is, what is the municipal rental value? It is called as MRV. Second point that you have to consider, what is the fair rental value? FRV. Third is, what is the actual rental value? ARV. Okay. First, municipal rental value. Second, fair rental value. Third, actual rental value. Out of these three, whichever is higher will be taken as the gross annual value of that house. First, what you have to do is, in the problem will be like this. Mr. X is the owner of a house which is let out on a monthly rent of 8,000 per month. The municipal rental value of the house is 12,000 per month. The fair rental value of the house is 10,000 per month. The house is given on rent for 8,000 per month. The SSC incurs expenditure on repair, insurance premium. The SSC is paying interest on loan taken to purchase the house. This will be the problem. From this, he will ask you to compute income from house property. That is what he will ask you. Compute income from house property. So he has given you information like this. You have to pick up only information that is necessary for you to compute income from house property. So the stepwise procedure to compute income from house property, I'm telling you now. Step 1, calculate gross annual value. Okay, these are the steps required to compute income from house property. This is the second head of income. Okay, step 1, calculate gross annual value, which is known as GAV. To calculate GAV, just now I told you, you have to take the higher of, whichever is more of, municipal rental value, fair rental value, actual rental value. Out of these three, whichever is higher is taken as gross annual value. That is step 1. Step 2, deduct municipal taxes paid by the owner from the gross annual value. Deduct municipal taxes paid by the owner. Okay. Now here you see, there are two important points that you have to remember here. Municipal taxes have to be paid. If they are outstanding, if they are due, deduction is not allowed. First point. Second, they have to be paid by the owner. If the tenant is paying municipal taxes, deduction is not given. Okay. So, first step, calculate gross annual value. GAV is the higher of MRV given to in the problem, FRV given in the problem, ARV given in the problem. Out of these three, whichever is higher is GAV. Okay. Second, deduct municipal taxes paid, underline paid, by the owner, underline owner. So municipal taxes outstanding, no deduction. Municipal taxes paid by tenant, no deduction. Okay. So these 2 points you have to remember. From the gross annual value, when you give deduction for the municipal taxes paid by the tenant owner, what you get is called net annual value. What you get is called net annual value, NAV. So GAV minus municipal taxes is equal to NAV. From the net annual value, there are two deductions available. Deductions under section 24A and deduction under section 24B. 24A is known as standard deduction or statutory deduction. 24A is standard or statutory deduction. What is statutory deduction? It is nothing but 1/3 of the net annual value. 1/3 of net annual value. That is NAV into 1/3. NAV into 1/3 is 24A, standard deduction. Okay. Why is this deduction given? Standard or statutory deduction? It is given for the owner towards repair and maintenance charges. Actual amount of repairs given to you in the problem, they have to be ignored. Take only 30% of NAV. Okay. Take only 30% of NAV as a standard or statutory deduction. Clear? After that, second deduction is 24B. 24B. 24B is a deduction which is given for interest on loan taken for the purpose of purchase, construction, repair, renovation, reconstruction. For these 5 purposes, if the SSC is taking a loan and he is paying interest on that loan during the previous year, he will be given deduction under section 24B. Okay. What is the amount of deduction? The amount of deduction is actual interest paid. Whatever interest he has paid, that will be given as deduction under 24B. So, certain important points that you have to remember with regard to interest on loan. All calculations have to be done only with regard to interest on loan. See, sometimes what happens is the SSC will take loan in 1 year. Say he will take the loan in 2020. He will be paying interest on that loan right from the first day of repayment. Will the house be completed within 1 year of the year in which the loan is taken? No. It may take 2 years or 3 years if it is to be constructed. If it is purchased, okay, you may take possession within 1 month. But for construction, it will take minimum 2 years to 3 years. Here what has happened? He has taken loan. He is paying interest on that, but he is not getting any income from house property because the house is still under construction. So this interest that he has paid before the completion of construction is called pre-construction interest. Interest paid before the completion of construction is called pre-construction interest. And pre-construction interest is given as a deduction in 5 equal installments beginning from the year in which construction is completed. Suppose, for example, you have taken a loan in the year 2020. Your house property is completed in this year 2023. 2020, 21 you have paid interest. 21, 22 you have paid interest. 22, 23 also you have paid interest. But when is your house constructed? Completion 23, 24. Okay. So you will start earning income from 23, 24. From this income, this pre-construction interest is given as a deduction in 5 equal installments. Pre-construction interest is given as a deduction in 5 equal installments beginning from the year in which construction is completed. Okay. This is the first point that you have to remember with regard to 24B. Second point, the loan has to be taken only for the purpose of purchase, construction, repair, renovation, reconstruction. If the loan is taken for any other purpose, deduction is not allowed. Okay, it has to be taken only for the purposes that we have mentioned just now. So from the net income from house property, when you give deduction under section 24A, which is 30% of NAV, and 24B, which is interest on loan taken to purchase, construct, repair, renovate, reconstruct the house, then deduction under 24B would be available. So from the NAV, net annual value, when you give these two deductions, what you get is called income from house property. That's it. Such simple thing it is. Okay. The resultant figure is income from house property. Now here, there are different situations that will arise when you are computing income from house property. The first one, the house property may be constructed, but it is not given on rent. The owner himself is staying in the house. When the owner himself stays in the house, it is known as self-occupied house. And for a self-occupied house, annual value is nil, 0. There is no annual value. So when there is no annual value, you cannot give deduction under 24A, which is for repair and collection charges, because the annual value is nil. No deduction under 24A. But 24B, deduction can be given. What is 24B? Interest on loan taken to purchase, construct, repair, renovate, or reconstruct the house. So where the SSC has taken a loan to purchase or construct the house, actual amount of interest paid during the previous year, reconstruction interest paid in 5 equal installments has to be given as deduction. So because of this, the SSC will have a loss from house property, where the house is self-occupied, that is occupied by the owner himself for his residential purpose. Then another situation, the house property may be used by the owner for his own business. When the house property is used by the owner for his own business, income from such a house is nil. Income from such a house is nil. Okay. Then next situation, the house property may be completed, but tenant is not coming and occupying the house. When no tenant has come to occupy the house, how will you get income? And how will you pay the tax on that income? So therefore, when the tenant is not coming, then you have to give what is called as vacancy allowance. That we will discuss when we are computing income from house property, that is the gross annual value. Okay. So this is a situation where the house property is lying vacant. Then another situation, the house property construction is completed. The tenant has come to occupy the house. The tenant has occupied the house, but he is not paying any rent. Okay. The tenant is not paying any rent of the house. Then how? When the tenant does not pay any rent, it is called as unrealized rent. So for unrealized rent, deduction is available. Okay. Deduction from where? Deduction from the gross annual value. Okay. You can give deduction from the, while calculating the gross annual value. In case the tenant has occupied the premises, but he is not paying any rent. Okay, that we will see when we are computing the gross annual value. Then another situation, there is one big house. The SSA has constructed the house. The house has got 4 portions. The SSC lives in the first portion. Remaining 3 are given on rent. Okay. Remaining 3 are given on rent. So in this situation, municipal value for the entire house will be given. Fair rent for the entire house will be given. You have to calculate proportionate municipal rental value, proportionate fair rental value. That is municipal rental value into 3/4. Okay. For example, the example that I have taken, there are 4 portions. One portion is occupied by the owner for his own residential purpose. Other 3 portions are given on rent. So rent received for these 3 portions would be the actual rental value. What will be the municipal rental value? Municipal rental value will be municipal rental value into, you have to take how much? 75% only, because 25% is self-occupied. In the same way, you have to take fair rental value also 75%, because 25% is self-occupied. Compare ARV with the MRV and the SRV. For how many months? For how many portions? For 3 portions. Whichever is higher of these 3 is the gross annual value. Okay. The next situation, there is one house, half of it is occupied by the owner, half is given on rent. In this situation, when you are calculating the gross annual value, you have to take MRV into 1/2, FRV into 1/2. Compare this with ARV for entire 12 months. Whichever is higher becomes the gross annual value. Okay, whichever is higher becomes the GAV. Okay, this is with regard to the house property, half being self-occupied and half being let out. So in your examinations, he may give you any kind of situation. In your examination, he'll give you any kind of situation. In all these kinds of situations, you only have to make changes with regard to computation of gross annual value. 24A and 24B, you just have to make adjustments accordingly. Okay. So this is how you calculate the income from house property. Any doubts up till here, children? Any doubts? Okay. So from where in this problem, what we will do is we'll pick up a problem where income from house property is given. But there are no problems where income from house property is given. Okay. Open to page number 94. Page number 94. In that, there are some self-examination, long answer questions, model examination questions, long answer questions. In this long answer question, question number 4, you see. In question number 4, he has given you rental income from the house. Okay. If you look at this problem, problem number 4, salary from a public sector company after deduction of income tax and provident fund contribution. This comes under the subhead salary. Income tax deducted at source. When you are calculating the entire total income, and from the total income, when you are calculating the tax liability, from the tax liability, deduct this income tax at source. Okay. Then contribution to recognized provident fund. Contribution to RPF, I have shown you, it comes under income from salary. Up to 12% is exempted. More than 12 is taxable. Interest on the contribution up to 9.5% is exempt. Remaining is taxable. Okay. And when you are showing with the other items under income from house property, so here the salary also is given. He has given you house rent allowance. Okay. Now, house rent allowance, I have already told you. When the employer is paying house rent allowance to the employee, this will be paid towards the rent of the house in which the employee is staying. Okay. And HRA is a partly taxable allowance. Out of these three, whichever is less is taxable, is exempted, remaining is taxable. What are those three? 1, actual allowance received. 2, rent paid minus 10% of salary. 3, fixed amount, 50% of salary if the employees are living in Delhi, Bombay, Calcutta, Madras. 40% of salary if they are living in other cities. Okay. So out of these three, whichever is less would be exempted, remaining would be taxable. This is about house rent allowance. Then leave travel allowance from the employer, of which 75% was spent on official duties. Now, in the last class, I was telling you about conveyance allowance. If it is conveyance allowance is paid for coming to office and going back home. If the allowance is paid to a person who is blind or orthopedically handicapped, okay, 1,600 per month is exempted, remaining is taxed. If it is paid to a normal person, 800 per month is exempted, remaining is taxed. But in the case of traveling allowance, okay, in the case of traveling allowance, unspent amount is taxable. That's what we have seen. Here in the problem, he has given you the traveling allowance and he is telling 75% is spent. Okay. 75% was spent on travel to hometown. How much is unspent? 25%. So from the allowance received, 75% is exempt, 25% is taxable. Okay. Then the next item you see, rental income from house, municipal value of the house, standard rent determinable, municipal taxes paid, interest on loan in respect of purchase of the house. These 5 items, that is rental income, municipal rental value, standard rent, municipal taxes, and interest on loan, they pertain to income from house property. Okay, they pertain to income from house property. Now, in this problem, he has given you rental income of the house. Okay, what is rental income of the house? Actual rent received, ARV, is the rental income of the house. Okay, then he has given you municipal value. What is municipal value? MRV. I told you a short while ago. Municipal rental value. Okay. Then he has given you one more thing, which is new to you, which is standard rent. What is standard rent? Rent fixed under the Rent Control Act is known as standard rent. Rent fixed under the Rent Control Act is known as standard rent. Whenever standard rent is given to you in the problem, then while calculating GAV, what you have to do is there has to be one more step that is inserted where standard rent is given to you in the problem. In that case, what you do is step 1, compare MRV with FRV. Select whichever is higher. This higher figure is called ERV, expected rental value. Compare ERV with SRV, standard rental value. Out of these two, whichever is less, okay, whichever is less, that has to be compared with ARV, and whichever is higher will becomes GAV. Okay, whichever is higher becomes GAV. So here what you are doing, very plain and very simple, don't get confused. First, compare MRV with FRV. Out of these two, take whichever is more. Okay, and compare this figure with standard rental value given in the problem. Out of these two, select whichever is lower, whichever is less, that you select. The selected figure, you call it as ERV, expected rental value. Then compare ERV with ARV, annual rental value. That will be given to you in the problem. Everything is given to you in the problem only. MRV will be given, FRV will be given, SRV will be given, ARV will be given. If, say, in this problem, FRV is not given, no problem, ignore it. Okay. If it is not there, ignore it. Assume if FRV also was there. If it is there, first what you do is compare MRV with FRV, select whichever is higher, compare that with SRV, select whichever is lower. Meaning that the annual rental value according to MRV and FRV should not exceed the SRV, should not exceed the standard rental value. That's the whole idea behind this. Okay. So it has to be limited to standard rent. Then compare the standard rent with ARV, annual rental value. Whichever is higher becomes GA. Okay. That's about this calculation of gross annual value. Then coming to interest on loan taken. Now, I was telling you, if the loan is taken for the purpose of what? Purchase, construction, repair, renovation, reconstruction. Then deduction can be given. In page number 94, problem is not given. Problem is given. It is, the solution is not there. I am telling you the solution. I am telling you how to solve the problem. Okay. You have to do your illustrations and then you will be able to solve this problem. So I'm giving you just an idea of how to solve the problem, how to do the calculation of gross annual value. Okay. And then some of you are asking me the PDF. See, this is, I'm just telling you the class which is indicative. Okay. For you, the study material is the only thing that you have to depend on. Okay. Depend on the study material. If you go through the study material, you will definitely get good marks. Okay. So coming back to the problem, interest on loan. Now in this situation, in this problem, the loan is taken for the purpose of purchase. So entire amount of interest paid can be given as deduction from the net annual value. Okay, after giving deduction under section 24A, which is 30% of NA. Okay, so you get the income from house property. Then the other usual deductions, deposits in cumulative term deposits of post office, purchase of NSE 8th issue certificates, purchase of units of UTI, payment of medical, purchase of units of UTI. Up till here, they all are known as qualified saving under section 80C. Then payment of mediclaim insurance premium, it comes under section 80D. And donation to an approved temple, it comes under 80G. So from the gross total income, when you give these three deductions, what you get is called total income. Okay. So far, we have seen income from salary, income from house property, and how to compute in a comprehensive problem when salary items and house property items are given. In the next class, I will talk about income from business and profession, which is very, very, very important. Income from business and profession. How to calculate income from business and profession. Okay. So with this, I am going to end the class because the time is almost up. Any questions you have got? In case you have any questions, please ask me. Otherwise, I am leaving the class. Tomorrow, you will have your class at 10:30 in the morning.
Okay, sir.
Okay. Any doubts? So you don't seem to have any doubts. I'm leaving the class. Thank you. Have a good day.
Thank you, sir.
Ini